market view, in a very precarious situation for the markets right now. Saurabh Mukherjea of Marcellus Investment Managers joining us on the phone line right now. Saurabh, complete turmoil in the markets. We wouldn't want to use the word panic, but do you feel that at this juncture, looking at how the last few weeks had progressed with the indices, on a valuation basis being one of the most expensive, there was something that was needed to break the camel's back, and this was it?
I wouldn't call it a panic because I think, looking at the screen in front of me, investors are doing what's rational. Nifty Banks is down 2.3%, Nifty IT is up 2.3%. I think this sort of move was long overdue where investors bought stocks which benefit from a weak rupee, and investors are selling companies which suffer as you enter the part of the rate cycle where rates consistently head north and the currency weakens. So it was a long overdue reversal and pattern where radically overvalued financial services stocks, wholesale lenders to be specific, got sold, and companies who benefit from a weak rupee got bought into. So I wouldn't call it a panic. I think investors are doing what's rational, what's right, and that's what markets are there for, to provide an efficient marketplace for the right sensible economic actions to take place.
But the timing of this and probably looking at investing some more money at this current juncture, would that be an advice, or still a wait-and-watch stance is more advisable?
Look, financials have been overvalued in our country for the best part of the last 2 years, and their financials have started correcting at more or less at the time of the rate cycle you'd expect them to correct, which is rates heading north, the economy is steaming along, inflationary pressures building up, the currency under pressure. Alongside that, the Fed itself in a rate tightening cycle. So wholesale funded lenders logically should correct when you are in a rate tightening phase of the economic cycle. And typically in our country's history, when the Fed starts tightening, within 6-7 months, BankX repeatedly has lost 30-35%. 2006, 2008, 2013, the long history of Indian banks correcting sharply on the back of Fed rate tightening. And as we've seen again in our country's history, IT and pharma are sectors which benefit from a weak currency. They do need that tailwind of a weak currency. And now that we have the currency having lost 65 to the dollar at the beginning of the year, now 74 to the dollar. That sort of tailwind will help the IT pharma sector, but also elements of the auto sector, the auto ancillary sector, which have export orientation, will also benefit. So I'm not so sure there's that much reason to panic for an investor who's sensibly diversified across sectors, but certainly not the time to buy financials. Financial services, wholesale funded lenders are still significantly overvalued by the Indian market. I think there's a long way to go there. I would say another further 30% correction in wholesale funded lenders is warranted.
Saurabh, do you think that we actually overshot, earnings growth in terms of the equity market performances? And this was probably required to bring it back to normalization?
So I think let's first focus on the market as a whole there. I think this is the first year, the current year that we're living through. Ironically, this will be the first year in the last 5 years where we get double-digit earnings growth. I still do believe, I think we are heading for double-digit earnings growth after a gap of 5 years. And yes, in the preceding 4 years, the market overshot itself. There's no great sort of sin in that. That's par for the course. That's par for the course in financial markets. Markets are intended to preempt the earnings recovery. Where I do get a bit worried is people believe the market will rise when there is no earnings growth, and the market will rise when there is earnings growth. That's really delusional. Typically, what you see is once the Indian economy steams into life, once consumption picks up, there are supply side constraints in our country, always have been there, and that in turn results in inflation flaring up, rates going up. And because of the peculiar nature of our lenders today, we have very few CASA funded lenders in our country. Primarily, they're wholesale funded lenders. As inflation and rates flare up, you get this correction, you get this sharp correction in financials. So I would say the market's around 15-20% overvalued, but financials is there. There's still, I would say, 30-35% overvaluation. And in a way, the bulk of the market correction will be via financial services stocks. But even as that happens, there'll be abundant opportunity to make money through IT, pharma, and export-oriented manufacturing stocks.
Saurabh, good afternoon. Just wondering, if you were to be writing out a note to your investors, current and potential investors, and if you were to assign a multiple to the markets currently, we were trading for the best part of 2018, circa 18 to 20 times. With this correction, with this higher cost of credit and with this Fed taper, etc., that you've all spoken about, do you reckon that the rational P multiple, the rational P multiple should be lower than where we might be currently, depending on what earnings estimate, of course, that you have?
I think we still India still at around 21 times forward, 21 times FY19. The market's still at 21 times FY19. 17 to 18 is our long-term average, has been for the last 10, 15 years. I don't see any reason why India doesn't warrant that 17 to 18 times forward earnings. So we're at 21 times forward, and I think we'll trace a journey back to around 17 times forward earnings. And in a way, the crux of that journey, retracement will be driven by financials.
So, Saurabh, the other bit is I heard you mention in one of the opening thoughts that you reckon that there is some more downside left for financials, wholesale lenders in particular. We've already seen a mean reversion of sorts for a lot of them, the highest quality names to the mid-sized quality names, anywhere between 30% to 40% from the highs that they've clocked in 2018. Are you saying there is still more 20-25% downside from these levels for these companies?
Yeah, so I think you've got to realize so far everything that's happening, rightly or wrongly, is happening on the back of conjecture and speculation, right, on ILFS and the coupons and the yields on various wholesale funded lenders. I think the journey ahead of us is, as these lenders try to refinance the monies that they borrowed last year, naturally they will have to pay significantly higher yields on the monies that they borrowed over the next 3-4 months. Remember, the 10-year bond deal itself is up 170, 180 bits, right? So the wholesale funded lenders presumably will pay a liquidity premium over and above that. That in turn creates its own issues around net interest margin and around NPAs. So far, by and large, the correction has been on the back of hearsay and speculation. The fundamentals of the situation in terms of higher cost of capital and higher credit costs, I think that's yet to play out. That will play out more gradually over the next 6 months.
Saurabh, I don't know if you want to answer this or no, but let me try. If you were to write a strategy note right now, you've crossed over to the buy side, I know, but if you were to be writing a strategy note today, would you believe that your target for the Nifty or the Sensex, as the case may be, would be way lower than what it is right now? 12-month target.
I think both in my appearances on your show and in my other media appearances, I've been saying for the last 12 months pretty much the same thing, that the market's overvalued. And I'm saying much the same thing even now. I think the Indian stock market still is 15% overvalued. And as I've said before, I reiterate, the crux of that overvaluation, the bulk of that overvaluation of the Indian market comes from an elevated price multiple attached to wholesale funded lenders. So as that elevated price multiple associated with wholesale funded lenders corrects, in a way the heat will be taken out of the overvaluation in the Indian market. And at the same time, in parallel, there'll be opportunities to make money in export-centric sectors.
Right. Sort of just one last question before we let you go. Just, comment on what we're seeing now for the debt mutual fund industry. Expectations are that there could be further pressure in terms of redemptions within the industry, and thereof the implications on equities.
I think this is one area where we do need regulators to step in and protect the liquid funds, because rightly or wrongly, the liquid funds have become the biggest suppliers of liquidity to the Indian financial system. As we all know, the PSU banks have been ground into dust almost over the last 6-7 years by their balance sheet challenges. And I think it's imperative that the regulators step in to provide a backstop to whatever ILFS related issues that the liquid funds might face. I think it's really, really important that happens forget the stock market, for the broader economy, for the liquidity provision in the broader economy. We do need the liquid funds to be looked after, and I sort of hope and pray that we get regulatory intervention on that front.
Got that. Saurabh, we leave it at that. Thanks very much for joining in. Appreciate you taking out the time and speaking with us here on the show.